G'day Internet, Max Wright here, and I'm very excited to introduce a brand new guest, someone I hope to have on the show regularly. He's got a lot of valuable insights in the world of macro, been trading for many years, and he's actually the inventor of the Hunter Algo. It's actually a tool to help traders know when to buy, when to sell, and so forth. So Daniel, thank you very much for being here. Welcome.
Yeah, thank you, man. It's really good to be here. And I know that you're really good in the macro space for understanding how it relates to crypto. And this is something I'm super passionate about. So I'm really keen to talk about macro, crypto, all that sort of stuff. So yeah, I'm glad to be here.
Good stuff. And it's always fun for me to hear an Australian accent. You might, for the viewers at home, you might hear my Australian accent get thicken up a little bit before the time this video is done. So cool. So listen, I mean, we had a little bit of a chat before this video started, and we thought, okay, well, what are we going to chat about? And there was just something that I saw recently, which I found really alarming. I thought it might be, a potential event that has a lot of profound effects throughout the macro world. And it was just an obscure little statistic that I saw that I just went, that's interesting. And that obscure little statistic is regarding the world of Airbnb, right? Short-term rentals. And something I saw was that of all Airbnb listings, 50% of them came online in the last 2 years. And I saw that and I was like, really? That is absolutely fascinating. And I just kind of started mulling that over. What does that mean? Where did it come from? Why did that happen? And it's like, okay, I understand we had, the whole world gets locked down for the obvious reasons. I don't want to say it. And then we get to, okay, now people come out of hiding and there's this massive surge of wanting to go on vacation again and travel the world and do all the things. And so what do they need? They need this, they need vacation rentals. So there's this huge surge of, probably a lot of amateurs first time, buying their first, second, third investment property, starting off trying to Airbnb things. And, there's a huge surge in market demand. So there's some validity there. Now, these people are out there getting loans. These are, it could be residential loans, could be fixed mortgage, but probably I think you'll find these investment loans are a little more than likely have a little more floating rate interest rates. We have interest rates going up all over the world. And I think we're headed into a very deep recession. Something that I'm not sure if my viewers know this, but several years ago, early in the trend, I got on the Airbnb trend. At some stage, it was my wife who kind of ran it. I actually owned 10 Airbnbs. And I wanted to understand how it was going to work because Airbnb, I think actually came out at a pretty similar time to crypto. It was around about 2009, Airbnb came out. So it never really saw a big downtrend. It was in its infancy in 2009. So I wanted to know, it's most akin to like the hotel market. What happens to hotel vacancy rates and things like that during a downturn? And I went and did the research, and the answer is it is severe. So 2009, 2010, vacancy rates occupancy rates, I should say, drop by 50% during a downturn in the market. If we are going into that now, which I believe most people think that we are, we could just see a massive, massive glut of Airbnb sitting there with properties. And these aren't homeowners. They're not passionate about it. It was an investment. It went tits up if it does go tits up. And they're just like, banks have it back. And it could see a huge glut of properties hitting the market if you see at the same time, people, tightening their belt. Recession's hitting, demand should go down. The stated goal of the Fed is demand destruction. Okay, well, they're going to get it. They're going to get it for sure. And so as people, it's like, okay, well, I can't go on these vacations anymore. That's one of the first places where people are going to, tighten their belt. And you might see a lot of Airbnbers just be like caught holding the bag, holding properties that they cannot make money on. So I thought that was a really fun topic to talk about. Daniel, what are your thoughts here? Because this affects the entire global real estate market. So what are your thoughts?
I think the Airbnb thing is a double-ended sword as well. So not only do you have less people wanting to basically rent your property, you have more expenses because the interest rate of your loan, which most of them don't even own a house. They get a loan for the house, which they then get rental people in for. So it's a double-ended sword. Not only do you make less money, you have more expenses. And the whole Airbnb thing is built upon a zero interest rate economy. That's like when it's been built from. It was like you said back in 2009. This entire business model was built basically for people getting zero to low interest rates and just buying all these properties and putting them on Airbnb. And yeah, it's going to be really interesting to see what happens. I don't think the Fed is going to, the Fed said last week, they don't plan to lower interest rates. They expect rates to be higher for longer. So the problem with interest rates is it's not the rise that affects people, it's staying up. Because if you have a variable interest rate, just because it goes up for a few months and comes back down, you'll be fine. But if the interest rate stays at 5% for several years, that's going to affect you way more than just the rise of the interest rates in the first place. And that's what most people don't expect. They don't expect the Fed to keep interest rates high because everyone is so used to a low to zero interest rate paradigm. And that whole paradigm is being shifted. And I feel like it's just going to be a realization that most people are going to have who have loans that, oh shit, the Fed's being serious. They actually are going to keep interest rates like really high. This is actually going to affect me. And yeah, maybe some people have a bit of a savings nest to account for the fact that interest rates are higher for a bit. But if interest rates are higher for many, many years, that people can't they're going to have to make lifestyle changes. And like you said, they're not going to be renting Airbnbs as much. They're going to be saving more money. It's definitely going to be a sort of recessionary vibe that people are going to be taking to their spending and saving and all that sort of stuff.
Yeah. Now, as you know, I hate to sound like a vulture, but you know, whenever I hear these things, like, oh my God, this problem. But that's the way I've trained my mind to think. I'm like, okay, so where's the opportunity? So I look at this and I'm like, okay, man, this could absolutely. So real estate is a lagging indicator. When interest rates go up, you know, you don't see this in real estate for 6 months, 12 months, 18 months, 2 years, and that's a real problem because it doesn't give the Fed the signals that it needs. Because to a reverse course, to slow down, to do whatever, right? And so real estate is one of those things that can get hit really hard in a year or two. So as much as my heart goes out to these people who are not seeing this, I mean, it's why I make this content so they can see this and get a heads up and, you know, plan accordingly. But obviously, you know, I wish more people viewed my channel than they do. But yeah, it's going to hit the world, right? And this is just one way it's going to hit the world. It's going to hit the world. You know, what's happening now with recession and interest rates. It's going to hit the world hard over many years to come. But the way my mind is trained to work is, okay, you know, where's the opportunity here? What can we do? And I go back to 2008, 2009 here, and I look at in America here, the biggest opportunities were where the biggest disasters were. So specifically here in the United States, we had in 2008, 9, 10, 11, we had Florida, Las Vegas, and Southern California. Basically the three biggest vacation destinations that we went to, because in a recession, one of the first places that people tighten their belt is on vacations. They go on fewer vacations, shorter vacations, et cetera, et cetera. And so that entire world and all the world around it. So in Vegas, it was all the, you know, the shows and the people, the casinos and all the people servicing the vacationers. All of that just gets stuck. Florida, just a massive, massive. It's where everyone wants to be all winter, all the snowbirds. You want to get out of your horrible, you know, blizzards and you want to go down to Florida and just have a good time, right? It just gets decimated. But in that decimation, you see the property market drops the most. It is the most vicious. It is the most brutal. But that brings about the biggest opportunities. The people who ran into those markets, Vegas, Southern California, and Florida, in 2009, 10, 11, they were the people who in the following decade got the biggest gains. But it was a graveyard out there. You know, it was just, but that's the opportunity. You can pick up absolute bargains. And then as the economy comes back, that's the one where the cash flow comes back. As soon as people can go on vacation again, they do. And so you start getting the cash flows from that. Are there any other thoughts you have on that, Daniel, in terms of opportunities and ways to, okay, we see this coming. We've got some time to prepare. How do we take advantage of it? And how do you see this playing out in the whole world?
Yeah. Well, as a general rule, the further out on the risk spectrum you go, the more volatile that asset class is going to be. So if you have a risk-off environment like a recession, the more risky assets are going to drop the most, and the more risky assets are going to rally the most when the economy does come back. So the more risky assets you buy, the more money you'll make after a recession. So what's the riskiest asset class you can buy? Well, probably crypto and NFTs. So as an investor, you have to think to yourself, how much risk are you willing to take on and how much money do you want to make essentially? If you're looking to make a bit of money and not take on too much risk, you should probably go into buying tech stocks or the like indices or whatever it is, or maybe even the stuff you're mentioning. If you want to carry more risk, but also have more potential upside return, you should be going further out on the risk spectrum and going into things like crypto and NFTs. So it really comes down to, what your level of risk is and how much you want to make essentially. And that's just like a sort of distribution of low risk to high risk. And you want to decide where you are on that sort of spectrum. For me, I'm young. I want to be taking on more risk. So I'm going to be focusing where I have the most edge, which is crypto NFTs. And also I think the most recession-proof industry is skills and network. Who do you know and what do you know? It doesn't matter what market you're in, if it's recession, if it's booming economy, if you have high value skills, if you know the right people, you'll always make lots of money. And you should never, in my opinion, rely upon a market in order to get rich. You should be able to get rich based upon your own skills and the people you know and the things you can build. So yeah, we're in a recession, all that sort of stuff. What's stopping, like what I would rather do is focus my attention on building cash flow, getting myself with different things that I can build to making, significant money. And that way, when the bottom comes, I have all this money that I can then put into markets and then grow it into more. So the most recession-proof thing is building skills, building network. That's what I focus a lot of my investments on if the markets are slow, so that when the bottom does come in, because I invested last year in my network, that's going to pay off this year, and I'm going to be able to make more money to then put in at the bottom. That's just my approach to investing, but that's more like a business owner approach, I guess. If you're an employee, I would say just cutting costs is really important. Don't do things that are going to decrease the amount of money you have to put in when we do get close to a bottom, because that's where the money's made, right? Back in 2008, if you bought pretty much anything after the dot-com crash, you would have made a significant amount of money by just being the one that buys near the bottom. So yeah, that's probably my answer to that.
Gotcha. So yeah, we've got the dot-com crash of the 2000s, we've got the housing crash and the real estate.
And the housing crash,
and the stock market crash 2008. And it's having the cash reserves to jump in, having the fortitude, the mental fortitude to jump in when everyone else is fearful is perfect. But then there's that fear exists for a long time as the markets come down. It's knowing when we get kind of near the bottom is the best opportunity. But the way, even that, I encourage people as a way to get that courage to act, right? I look at that. If you go back and look at these, big things, let's say go all the way back to the Great Depression, and you see 1929 is the top, and there's this journey down, and there's probably a whole bunch of times you can think about, even if with the benefit of hindsight, you can look back and you're only halfway down, and you're thinking, okay, also, it's come down a lot. Maybe it's time to jump in. And even if you got that wrong, you were nowhere near the bottom. You're only halfway through that period. It only takes sort of 3-4 years for it to come back to the level where you bought in, I should say, right? Had you bought at the very top, it took 15 years for the markets to go back up to where you bought in at, right? And that is to lose 15 years of your investing life, having lost money on that investment. That is brutal. It's a very, very bad. But if you we are already, we're a good chunk of the way into this. Now, I think there's more to go, and I hope we have a conversation about that here in a second. I think there's more to go, so I'm not jumping in yet. But I just share that anecdote with people to give them courage that even if you mess it up from this point, just having waited this long, you've done yourself a huge service, because on the tail end of this, you're probably, back to break even, 7, 8, 9, 10 years earlier. And that's a really, really powerful concept to have and to give people courage. So you brought up crypto. It's a beautiful segue. Let's get into crypto because it's more your specialty. It's more my specialty. Bitcoin and the crypto. Well, Bitcoin's broken out of a very, very important trend line. It was a downward sloping trend line, and it is not that Bitcoin's gone up, but it has crossed that trend line because that trend line kept going down, and Bitcoin has stabilized here in this region. I want to hear your thoughts. Do you think we're at the bottom with crypto? Do you think there's more to come? How does it relate to macro? What are you sort of seeing here in the next 6, 12, 18 months?
Yeah, good question. So the Fed last week basically said in one of the in what they said, they had one point which was really interesting. They said that they expect that they would basically prefer for things to begin breaking and for them to have to come in and provide stimulus than for them to not do enough and have inflation continue to be high. So they would rather break things and come in and fix it than not go hard enough. And what that basically means for markets is they would rather shit hit the fan and for stocks and everything to go lower than for this to be the bottom. And that tells me that there is a high probability that we do have one more low where we have things to begin to break and we have a real proper sort of capitulation event. If that happens, then that takes Bitcoin, I would say, to about 13 to 16, 17K. And I think if Bitcoin gets down to that level, that's the level of capitulation and fear where things start breaking. And I would expect that the Fed comes in then and they start to save sort of the markets and stopping things from going much lower, because that's I feel like the point of that's like maximum pain in my opinion. So it's either the low's in and the Fed doesn't get to a point where things begin breaking, it doesn't break, or things start breaking, we go to a new low and Bitcoin is getting to like 13 to 16K. But my system that I follow, the Hunter Algo, it signaled that the bottom was in at the recent, like the low we had, like the lowest point that we had in the past few months. And we've gone up and we're sort of coming back down, and we're a little bit off where we bought. So my algo has said that the bottom's in, but we could go to a new low. But yeah, basically because the Fed said that, it's increased in my mind the probability that we do go to a new low. But like it's honestly hard to tell. I'm basically dollar cost averaging with my own system and just following the algo. And I try not to pay too much attention to like what I think is going to happen, predicting the future, because I've basically outsourced all that thinking into the system that I've built, which is the Hunter Algo, which does the thinking for me essentially. But yeah.
And let's talk about that for just a moment. We talk about just trading psychology, the importance of discipline, the importance of building systems so that you don't become emotional. Let's talk a little bit about that. What's the strategy behind that? Like, it's because on the one hand, let me try and play devil's advocate for the moment here. It's like, well, if you could just program a system to tell you what to do, then I don't know, so that someone would figure out that system and we could all just invest in that fund. And it by definition kind of has to not work. But compared to, trusting on your own emotions and your own things, it's like weighing that up. Just kind of talk about that a little bit if you could.
In all areas of life, if you don't in all areas of life, most people fail because they attribute what they want to happen to hope and just sort of dreaming. They just don't have a system, and they just expect that, oh, well, when the bottom comes, my future self will be ready and I'll buy the bottom and I'll be fine. I was doing that for years when I first got into crypto in like 2017, and it didn't work. Like the bottom would come and yeah, I thought I would have bought the bottom and maybe I bought a little bit, but I never was able to go in with conviction because I didn't have parameters put in place which would force me to act on when I knew the conditions had come for me to like buy. So I realized that I can't just expect that I will just know when the bottom's in and that I will just put in the amount I need to. So I decided, you know what, I'm just going to build a system that will be able to tell me with a pretty good accuracy where the bottom is and where the top is. And I'll follow this system. Because if you have something that can hold you accountable, the chances of you actually doing what you need to do is so much higher. And that's just what I've found like most people struggle with. Even if your mental fortitude is strong, it's such a difficult thing to buy the bottom. It's so hard. And I would say less than 1% of people ever get it right. And even if you get one bottom right, the next bottom you might mess up. You might mess the top up. Maybe you're not as good at selling. Most people struggle at selling more than buying as well. So I know what you said. What you said is interesting. You basically said, if everyone in the market has your tool, why would it work? And I would say that is very true for every single system in crypto, except for mine. And this is an interesting thing, and I'll explain why. The data that I use to make my tool is called funding data. Funding data measures what people are doing in the market. And if the data says that everyone is shorting, or if everyone is fearful, that is what they are actually feeling. And it doesn't matter how many people see that others are fearful. It doesn't change the fact that they are fearful. You can't front run the fact that everyone is fearful and sold. So if everyone is looking at data where everyone is afraid and most people have sold, it's like it can't be front run. It's sort of weird. If everyone's looking at an algo that has a line and the price has to hit this line for it to signal a buy signal, obviously people will buy before the line. But when you have a data set which is based upon how people feel, people can't change the fact that they are afraid. And you can't change the fact that markets bottom when people are most afraid. So it's sort of a system that can't be front run. And it doesn't matter how many people look at this data, it doesn't change the fact that that's what the data is showing you. And if you go on Twitter and you look at stuff by some really, really smart guys by LoomDart and a few others, they say this as well. Funding data is the only data set pretty much in existence where everyone can look at it and it can still be right. So it's really interesting. I will send it to you later.
Sorry, what kind of data? Can you repeat that? What kind of data?
Funding data.
Say it again. I'm missing the word.
Funding.
Funding data. Funding data. Okay. So meaning, explain what that means.
So if you go on BitMEX or Bybit or any of these like decentralized sort of trading exchanges, if you go long, you have to pay or you receive what's called funding data. It's basically like on these decentralized exchanges, sometimes the price on their exchange changes from Coinbase and like normal exchanges. And they don't want the price to change on different exchanges because it causes issues. So what they do is they will punish or reward a buyer or a seller depending on what they need to do to get the price on their exchange equal to another exchange. So let's say on Bybit, a degenerate leverage exchange, the price is $1,000 above Coinbase, the normal exchange. This is the reason it's higher is because there's more buyers on Bybit that are, let's say everyone's using 50x leverage, they're all buying, pushing the price up. They don't want to encourage more people to buy. So what they do is they will punish buyers on Bybit by making them pay funding to people who are shorting. So this encourages people to do what will bring price back to where Coinbase price is. Now, if everyone is pushing the price on Bybit above Coinbase, what is that a reflection of in terms of what people think is going to happen on Bybit?
People on Bybit believe the price is going up.
Yeah. And what do most people in markets, what happens to most people in markets? Like, do the herd make money in crypto?
Typically not.
So if you do the opposite of what the herd is doing, based upon the funding data, you're able to pick tops and bottoms because it tells you what the average market participant thinks in their mind and what they're doing. This is why most algos are bad, because they don't actually look at the market positioning. What are people actually doing in the market? Well, funding data tells you what they're literally doing. So that's why it's a good data set.
Nice. Oh, very, very good. All right. Well, cool. Thank you for that. And that concept is the basis of the Hunter algo.
Basically, yeah.
Yeah. Awesome. Very cool. Anything else you want to talk about today?
I think we'll try to tie this back into how people can basically be able to buy bottoms and tops. So that was something that I think you were going to reply back on. How you believe that people can hold themselves accountable and build mental fortitude and all that sort of stuff to buy the bottom. Is that something that I think you wanted to comment on?
So I completely agree with you, Daniel. I think that's the unbelievably most important thing here, is that it's so important to realize that we as human beings are just dictated by emotions, and they're powerful. And when money's on the line and your savings are on the line, those feelings are powerful and they distort your mind. So fear takes over you, greed takes over you, all these different emotions take over you, and you just do not think clearly, and you get confirmation bias when you have greed. The greed glands are firing up. You're also when you're fearful, you don't look at the positive situations. You're like, okay, there's actually a fair amount of arguments to suggest that things are not as bad as I think, and we just tend to miss all that. And this is it's a psychological game that absolutely every single human being has going on inside of them. And that's why I think this leveraging these tools like the Hunter algo are so important. Just recently, a couple of days ago, I have one of my favorite guests here I have on the show, Juan Villaverde, and he developed this timing model. He's and he's just telling me, this signal is just starting to flash. It's like we're at the bottom. It's time to buy. We're very, very close to it. And my emotions are telling me, it's like, I don't know. I think this macro situation is way scarier than what you're saying. But his algo is telling me, it's like, no, we are close. We are very, very close to it in the world of Bitcoin, at least. Anyway, he's not saying that for real estate or other areas, but he's saying it for that. And so I've started to leverage these tools, bring this in. It's why I kind of wanted to chat to you. It's why I speak to Juan. It's why I speak to a lot of the people I do. It's like, okay, let's bring these things in and leverage on these tools because they're very, very important. So I think it's a really, really good point to talk about. And by the way, guys, at the end of this video, there'll be a link to go and watch that interview with Juan. He talks about his timing model. He talked about exactly the stages of when it's going to fire and whether or not it's fired or not. So you make sure you want to go and watch that next. So yeah, I think that's really, really useful. So cool. Well, Daniel, it's been an absolute pleasure chatting to you so far, buddy. I hope we get to see you again. Guys, make sure hit the like button, hit the subscribe button, and click this video to go and watch that incredible interview I did with Juan Villaverde. It's an absolute cracker, and I will see you soon. Now, if you want to see the original video with Juan, I highly recommend you go ahead and click this link right here, because in that video, he shares his top secret formula for his timing method to know when the bottoms will be in markets, and he actually reveals whether or not that signal has been triggered or not yet. So go ahead and click this video now.